Welcome to the Rosenberg Roundup, a weekly podcast providing investors with key macro and market developments, insightful data analysis, and actionable ideas that are top of mind for the Rosenberg research team in the week ahead.
I'm Dylan Smith, and welcome to the Rosenberg Roundup. My co-host and comrade in arms, Jacob, is still absent. By all accounts, the wedding was a huge success, especially judging by the state of our inboxes on Monday morning after the wedding. No emails from Jacob or from Dave, which means they had a good time. You're stuck with me for another week, and boy, do I have a lot to tell you about. It was a fascinating week in markets. We'll spend a good amount of time breaking down what happened on a very wacky Wednesday after the latest US inflation data came out. But our spotlight this week will be a follow-up on our gold conversation from last week's podcast. Because you've been asking us, what about silver? What about the gold miners? Well, we'll address both in relation to some pieces that we put out this week on that topic. And I'm very pleased to say that we'll be stopping by Canada Corner to pay Uncle Tiff Macklin a visit and see what he's been telling us about rates north of the US border. And with that to look forward to, let's start with the week in review. And what a week it was. You've heard of Black Friday, you've heard of Black Monday, you've heard of Cyber Friday, you've heard of Pfizer Monday. And this week we had a strong case for christening a new special day. Maybe we'll call it Weird Wednesday. Although if you ask some on our team, WTF Wednesday might be a lot more apt. Why was it so weird? Well, we got one of the largest market overreactions to one of the smallest data surprises that we've ever encountered, and that Dave in his 40 years in the markets has ever encountered too, so it's not just me. First, we'll have a look at what happened, and then we'll get to what it actually means. So we had US CPI out on Wednesday. We've been drawing attention to inflation prints as very important for the monetary policy path. And before the release, the Bloomberg consensus, or the economist consensus, was for a plus 0.3 month-on-month move, right? A little above target, but nothing spectacular. The actual release came in a touch above that at plus 0.4%, although to the second decimal, it was very close to being rounded down to perfectly in line with expectations. But from the reaction in markets, and bond markets in particular, you would have thought we'd gone back to the days of 9% year-on-year inflation that defined 2021 and 2022. Treasuries absolutely collapsed, and the 10-year yield was up almost 20 basis points. The daily market move was a full 3 standard deviations from what you'd normally get, and for the non-stats nerds, that puts you in the little area right at the far end of the bell curve. The move ricocheted into equities, with the S&P 500 down almost a full % to close the day, and the dollar index was up by the same proportion. But probably the most shocking change in market pricing was the shift in implied expectations on rate cuts. We went into that CPI release on Wednesday morning with markets expecting a 60% chance of a Fed cut in June, and still around 3 cuts for the totality of the year. Post-meeting, that lay at 20% for June and less than 50 basis points of easing by the Fed by the end of the year. That is an enormous one-day change in consensus expectations. So what was actually in this horrific inflation report? Well, actually not much new. We had a rise in energy prices on the back of higher fuel costs, as expected, and that rise was actually a bit smaller than we saw in February. Encouragingly, it didn't seep through into the pricing of things like transport services or delivery services. Beyond that, all the action was in what we call non-cyclical components, so things that don't actually respond to interest rates and the economic cycle, at least not rapidly. Those included rents, which are still rising, but bear in mind that these are due in moderation. New rental contract prices are actually falling, but there's a long lag in rent prices because of how statisticians impute contract rollovers and so on. So some rise in rental prices, but not massively concerning. The other 2 big contributors were health services, and healthcare is basically a market of its own with very little to do with the real economy, and a massive one-off move in auto insurance prices. Again, probably a one-off due to the insurance industry's lumpy price-setting schedule, and bear in mind that vehicle prices actually fell on the month. But for some reason, the reporting on TV, on Bloomberg, on CNBC right after the release kept referring to broad inflationary pressure. But delving into the report, we couldn't find any evidence of that. Goods prices outside of energy deflated. They were down 0.2% month on month, and cyclical service prices fell or stayed roughly level. To drive that point home, here's a list of categories where prices actually declined. Sporting goods, toys, recreational services, appliances, car and truck rental, new cars, airfares, even with higher fuel costs, furniture, and home improvement. There are a bunch more releases with only slight increases or which were flat on the month. So reports of a broad-based increase in inflation are greatly exaggerated. In fact, if you take out rents, medical care, and auto insurance from core inflation, the rest of the index rose just 1% year on year, well below target. So there are a few hard-to-control bad apples driving inflation, but overall price pressures are not much to worry about. So what do we think actually happened here? Why did the markets react so much? Well, the context of this release was important. We'd seen a week and a bit leading up to this data point of fairly confusing Fedspeak, with the different voting members of the rate-setting committee all contradicting each other and sometimes contradicting themselves, but an overall message gradually emerging, bringing the Fed's 3 cuts price into the dot plots into question. We also had an upswing in the March data on the real economy and activity, as we've discussed in this podcast. And we also had last week's strong headline on non-farm payrolls. So there was actually quite a lot riding on this CPI number in retrospect. Less inflation than expected would have calmed markets down, but against that backdrop, another miss, seeming to confirm this apparent stall in inflation just above 3% year on year, was enough to convince everyone that a June cut is probably out of the picture. So there was a spring that was coiled, and the type of move that usually takes a few weeks to play out happened in about 30 minutes after the CPI release. And one little epilogue to that story is that on Thursday, we got the latest data on producer prices. So that's input prices before it gets into the shops and into the consumer's hands, which reliably lead consumer prices in the CPI. That came in below expectations on Thursday. It brought yields down a little, but there's still been a big net tightening in financial conditions. And even if the Fed's not in a rush to cut, that's probably not the outcome that they wanted from this week's data. Turning now to the week ahead, we'll touch on the data in a second, but let's stay on the topic of the Fed for a moment, because what the committee members say in the wake of Weird Wednesday will be absolutely critical for driving markets over the short term. They've already been out and about on Thursday and Friday, but after a weekend of reflection, we'll have to see what the updated messaging is. So here's who's on the calendar for next week, although more could be added. On Monday, we have Lori Logan of the Dallas Fed and the San Francisco Fed's Mary Daly, two of the more considered thinkers on the committee, we'd argue. On Wednesday, we have Mester of the Cleveland Fed, and on Thursday, we have New York's Williams and Atlanta's Raphael Bostic. That's what's on the schedule for now. Of course, more could be added. And on the data front, we have a full rundown on the U.S. economy coming from various sources. We have the University of Michigan Consumer Sentiment Index and Inflation Expectations read coming out. We have industrial production for the month of March. We have retail sales, and we have the leading indicator update as well. Finally, the Fed's Beige Book, a very important source of data for them, which compiles all of the reports from the regional Fed's business contacts. That will be coming out mid-next week, so we'll be updating our natural language-based sentiment index that does the reading of the report for you and basically tells you what it said in relation to various portions of the economy. Turning now to our spotlight for the week. That was a big week in review, so we'll keep it fairly tight here. There was a lot of great research from the team this week on various topics. My colleague Atakan published some excellent work on how the surge in undocumented immigration into the US, which is very difficult to measure in official statistics, could explain some of the data divergences that we're seeing, particularly between income and expenditure. We also had senior strategist Bhavana Chabra, who has been covering what to expect in the upcoming earnings season, very big one for Equity Outlook. But we've been receiving great feedback and a lot of interest and engagement on our gold focus from last week, so I'm going to highlight a series of follow-up pieces that we put out this week, mostly done by my colleagues Marius Youngstra and Paul Kim. And we've been looking at the implication of surging gold prices for two kind of adjacent markets. One is gold mining stocks, particularly in North America, and the other is the silver price. Starting with the miners, you'd think with gold up almost 20% over the last year, and even more on a slightly longer horizon, you would think gold miners would be flourishing. But since April 2023, over which point gold has risen over 15%, gold miners are actually down 2%. despite a recent recovery as the gold price has risen more. That's all to do with rising costs and declining profitability. The crucial metric for gold miners, which is cash flow per ounce of gold sold, is down, even with prices up. And that's, from a gold perspective, that costly production is part of what's limiting downside risk on holding gold and putting a floor on the price, essentially. But it also means that gold miners are struggling to make high margins despite the price rises. But our piece was about why gold could get as high as $3,000 and beyond, and further upward moves on gold would actually bring the miners into more profitable territory. In our $3,000 gold scenario, Marius estimates around 25% upside for the gold miners at current profitability levels, and even more if their efforts to improve costs and capital discipline bear fruit. The picture on silver looks actually fairly similar from a return profile perspective. We spent a lot of time looking at the gold to silver price ratio, which is extremely stretched at present. So it does look like a bit of catch-up is due from silver. And if gold continues to move upwards, we think we see a range of around 35 to 60% upside for silver. Now, that's big, and that's a wide range. And where we fall in that range probably depends on the industrial outlook for silver. Unlike gold, silver is at least half driven, in terms of demand at least, by industrial factors. So based on the current slump in global industrial production and the blip in renewables demand we're seeing, we're probably going to be on the lower side of that range, around the 35% mark. But if you're a believer in the soft landing and you agree with recent commentary that we might be seeing the bottoming of the global industrial cycle, then silver might be a great way to play that particular theme. So those are some of the ways to get some underlying exposure to gold. Both require a bit of an extra leap of faith. For the miners, that cost controls are there to protect profits, and for silver, that industrial demand is going to pick up, and particularly solar and EV demand. But if you want to find out more, we have a special promotion on at the moment related to our research on the broader gold complex. If you sign up for a free trial now, link in the episode description, or you can Google it on our website, then we'll send you, free of charge, our special report on gold, along with that research on silver and the gold miners. Just leave a note for our sales team, letting them know that you've come from the podcast when you sign up. Although the major US-Canada border crossings at Niagara and along the St. Lawrence River were shrouded in darkness this week, at least for a few minutes of the total solar eclipse in the area, we were able to pop over for a quick visit to Canada Corner, and specifically to the Corner.The Bank of Canada Governor Tiff Macklem's media briefing room, where he was announcing his council's latest rate decisions. As expected, there was no actual change in rates, but these meetings are never about what's done. They're about what's communicated for the future, and Tiff did lay out the path to cuts. It's all about core inflation. Perhaps he was reading our research about how the labor market is signaling a recession in Canada, and how the housing market should not be a barrier to starting cuts, although it may affect the pace of cutting. Gone were Tiff's previous references to shelter inflation, risks from the housing market, and even what he wants to see on wages in order to cut rates. All the bank has signaled that it wants to see is a couple more good core inflation prints, as we've seen recently, ahead of the next meeting in June, and so they are lining up whatever happens at the Fed to begin easing in the near future. We'll actually get the next CPI print next week, so stay tuned. And we'd be remiss not to point out that across the pond, the European Central Bank did the exact same thing. The ECB uses fairly explicit language in their forward guidance to signal whether they're on pause, hiking, cutting, and they switched from their language about being on hold to language which essentially said preparing to cut, and they also flagged underlying inflation as the key metric that they need to see to get them into the home stretch. So coming out of this week and wrapping up the entire show, it's looking increasingly clear that we're going to see global rates falling and preparing to fall at a time when US rate cuts are being pushed further out and probably a little slower and staying high. So we would suggest you buy some dollars. That brings us to the end of today's pod. We'll be updating you on the outlook as markets process the aftermath of Weird Wednesday. Until then, don't forget to like and subscribe. Tell your friends about us, and do leave us a review if you have half a minute. It helps us get the word out. I'm Dylan Smith, and that was the Rosenberg Roundup.
Thank you for listening to this week's episode of Rosenberg Roundup. For more information on our work and to take advantage of a free 30-day trial of our research, please visit rosenbergresearch.com. Make sure to tune in to our next episode for more insightful analysis on the macro and market landscape. Rosenberg Roundup is provided for general information and entertainment purposes only and does not constitute legal or professional advice, nor is it an offer to sell or a solicitation of an offer to purchase any security or derivative. Any views expressed by the participants of Rosenberg Roundup are solely their own and do not necessarily reflect the views, opinions, beliefs, or policies of Rosenberg Research.